Hello, everyone. I hope you're having a fantastic day so far. Today, I want to talk about tariffs, and what it really means and how it affects us all. And of course, I'm new to all of this stuff in terms of understanding, but I'm just going to try and break it down based on what I understand. So, the USA under Trump's leadership has decided that they are going to impose tariffs on different countries, and there are three different categories, so to speak. Just call it sort of like red, amber, green, or lower, middle, higher, or whatever it may be. So there are some individuals or organized or countries, should I say, who are getting lower tariffs, so to speak, at 10%. You've got other countries who are getting 20%, mainly within Europe, and you've got other countries who are 30% plus in terms of tariffs imposed. And so those are countries like China, Vietnam, um, and a few others as well. They're not coming off the top of my head. And so, what is a tariff? A tariff is essentially a tax, really and truly. And if we understand how the market has really worked, it's all been based on free market trade, essentially, or at least reduced tariffs in terms of, percentage points, etc., etc. So there are certain things that definitely get tariffed, and other things that definitely don't at all. And so thinking about it, Trump's rationale is, well, we I'm making these numbers up. We buy roughly 6 trillion US dollars worth of stuff, um, but then people only buy 4 trillion US dollars within our country. So what's going on there? That's a deficit of 2 trillion each year, or however much the duration is. And so therefore, in his mind, he's thinking, yeah, like what the hell? Um, I'm gonna tariff everybody up, which is mad because everyone else is like, are you crazy? You're going to crash the economy. Maybe there's a thought there. So with that in mind, the way it works, is my understanding, is that if you have I don't know, a business, okay, in the USA, and essentially it sells Japanese or Chinese cabbages, okay, it's random. You're going to potentially, bring in those Japanese or Chinese cabbages into the USA, and then you'll stock them on your shop floor. So maybe you pay £50 for those. But now, because there is a, let's say, 50% tariff on top of it, okay, you're not only just paying £50 to bring them in, you're paying £50 plus £25, which is 50% of that sort of like product. So you're thinking to yourself, well, I used to sell these at £60. I can't do that now. I'm going to sell them at £85. I mean, there's some bloody expensive cabbages. So now you're selling them at 85. Why have I chose 85? Because you've got the price to bring it in, which is £50. Then you've got the £25 on top, which is the 50% tariff. Then you've got the £10, difference that you're looking to keep in terms of fees. So you're making £10. Of course, your customers are going to be saying, well, why am I now paying £85 for cabbages, Chinese cabbages, when I used to pay only £60, as an example? That does not make sense. In fact, I'm going elsewhere. I'm going elsewhere to get business. So that's one scenario. The other scenario is, well, the business owner may not be able to even afford that initial £75 to even think about adding £10 on top. So to save themselves any embarrassment and any heartache, should we say, or difficulty, they decide not to buy any more cabbages, and in fact they decide to not focus on that business anymore. So they close down. So that's potentially what ends up happening. You end up having a situation where business behavior starts to change. It starts to change. And I guess, there is an alternative to this where, well, do we start doing things homegrown? Do we start doing things internally? But how long is that going to take? In terms of, like, they won't be Chinese cabbages anymore. There'll be USA cabbages. So does that kill off certain industries or certain niches or certain areas within a country? Possibly, yes, of course. And if we come into sort of like the job market pressures, what that means is there ends up being decreased demand for certain stuff, which means certain businesses may go out of business, so to speak, or may not be around for whatever reason, based on the fact that the original business can't even afford to import those goods. They can't afford to do it. And so this has a direct effect on the labor market. What parts of the labor market? I'm not an economist to know that, but I'm sure it has a big effect on many different areas. Now, of course, this is not on all products. So I think things like Shein and Alibaba, some of those things at least anyway, are not heavily affected. But there are other things that are definitely affected, such as metals, ores, raw goods, etc., etc. Now, this initially doesn't have a direct effect on services, but it will. And in some ways it does already, because everything affects everything. Okay. So services are affected in a different way. There's a back end effect. And so what ends up happening, and you would have seen this, is that the stock market, all of that stuff starts to get affected. You know, businesses or investors start to sell their shares because they have low confidence in the fact that certain companies will be able to survive during this tumultuous time. And so you see the stock market start to fall. Okay. You can look at the NASDAQ as an example. Okay. Whether you just check that out on Google or Trading 212 or Trading View or whatever you use, you'll realize that there's just been falls. So for the traders out there, they're going to be selling as opposed to buying. But of course, for those who are investing in stocks and shares, index funds, ETFs, they will either decide to, again, sell their shares or stocks or whatever it may be, or just keep on buying with the belief that the market will bounce back. And this is just a temporary measure. So it's a discount. And this is what they mean about opportunities for businesses. So there is that. Now, what ends up happening when investors sell? And we're talking about big investors here, okay? What they may do is find an alternative haven in order to essentially protect their money. Now, before I get into that, you know, there's this whole idea that tariffs have the potential to generate revenue for the US. What do I mean by this? Well, there may be this belief that actually businesses around the world, not even businesses around the world, businesses within the US are happy to, provide the means towards those tariffs, but also it may encourage sort of ingenuity, innovation, the development of manufacturing within the US as well, as an example, and other areas as well. But you have to remember, these countries may decide that actually one size does not fit all, and we may decide to go elsewhere to get business anyway. So why are we relying fully on the US? So there's a whole host of different scenarios that could happen. But let's come back to what happens when investors sell. So typically what happens when investors sell is that they may invest in a more safer asset class. And in this instance, it potentially could be bonds. Okay, so remember I did that video the other day about bonds. If you haven't watched it, definitely check it out. Where a bond is basically an IOU or a contract where essentially a country sells off a bond, okay, for money at a certain interest rate, okay? And why is this important? Well, and I think this is the figure, but you can check yourself, and I'm always saying this to cover myself. I think the US is roughly in 36 trillion US dollars of debt, okay? And I think in the next couple of months or so, it's difficult for them to service that debt. And because interest rates are high at the moment due to an inflationary environment or gradually increasing inflationary environment, which has been propagated by this, by the way, if there are more investors buying bonds, what happens is demand increases. So what do I mean by this? You've got an activity where you have low investor confidence in businesses on the stock market. Then what ends up happening is those investors go to the bond market and buy up bonds to, again, grow their money, protect it, all of that kind of stuff there, because governments always pay that bond money back, so to speak, because this is basically an IOU. The private investors are not just investing in this stuff just because, it's safe. It's safe because the government owes them money. They have to pay them back the money that they used to pay for that bond. And so if loads of investors are doing this, the price of bonds goes up, but the interest rate, the yield, the money that the investor gets back over 5 or 10 years reduces, because it's typically fixed, so to speak. As an example, at least anyway, I think it's fixed, because that's a really key point. So if it's fixed, then the pie is getting smaller as this. So let's say, for example, this is the core price of the bond and this is the interest rate. If this gets bigger, then this gets smaller, because it's a proportion of it. I'll give you an example. Let's say, for example, the interest rate is fixed at like 10%. I think that's the easiest number I can think of. Let's say it's fixed at 10%. Sorry, it's not even a percentage. Let's say it's fixed at a certain amount. So let's say it's fixed at £50 and the cost of a bond is £100, okay? Even though they get more for their money, if the fixed rate of the bond goes to £2,000, it's still fixed at 100. Was it £100 I said? Or £10? I don't even remember. The point being made is that the yield or the interest rate is the same, which means they're getting more money but a cheaper deal in a way, because the interest rate is less, because usually governments pay back interest first. And so what ends up happening is that there is incentivized borrowing. There is more borrowing that happens, where they can use that money to, again, innovate and create opportunities within that country. And in light of what was being discussed in terms of Trump coming into power, there's all the efficiency stuff, the AI stuff, the tech stuff, the manufacturing stuff, the fracking stuff. There's all of that stuff to fund. So that's what comes into play. How does that affect the working person? Well, if the yields decrease, okay, due to high demand because they've increased the bond prices to control it, then what ends up happening is you may start to get an inflationary environment, which basically means people start to pay for things more and get more credit and stuff. And so the rate of goods and all of that kind of stuff may increase because it's triggering activity within the system. It may mean mortgages may decrease in interest rates, and there will also be a decrease in terms of ISAs and all of that kind of stuff, equivalents within the US. Of course, this has a knock-on effect. And so you can see very clearly that actually there could be a whole game that's being played here that forces the hand of the socio-economic climate. Now, of course, what could happen with the trade stuff, the tariff stuff, should I say? There could be trade wars, if you put this on me, I'll put this on you, and then they go back and forth. There could be this whole idea of stagflation. So I've got my notes here. This is a combination of rising inflation due to higher import costs and slowing economic growth from reduced trade. So this is what I was saying at the beginning, essentially. Because it's more expensive to import this stuff, there is an increase in prices, which means that it's harder for people to pay for stuff, which means that the economic growth, which means the productivity with the country is lower because people are spending less. And there could be currency fluctuations. So tariffs can influence exchange rates, as affected countries may experience changes in trade balances, impacting currency valuations and in international investment flows. So that's what ends up happening, or could happen. This encourages diversification of potential partners being formed, okay? So that's one thing. And of course, China are, I was going to say pissed off, are annoyed. Of course, what are they going to do? They're probably going to look to Africa for other things that they can do and really invest in there. But of course, Africa will become another playground, which is very frustrating. There could be a focus on investing in domestic industries. But of course, there will be increased sort of like approaches towards diplomacy, which is what the UK are doing. Okay. So I've spoken about what tariffs are, why I believe they are, how it affects the economic fabric, and how it could affect you when it comes to credit, mortgages, also pensions and insurance. You may not get as much as you would like to get. Why? Because, of course, the private investors are hedge funds, insurance companies, pension companies, all this kind of stuff there. It's all affected. It's all affected in the name of borrowing cheaper from the government and spending it on different stuff, trying to boost the activity of the economy. And of course, if that stuff happens, you can start to place some really predictable bets in terms of where you invest your cash, whether you are a trader or an investor. Lots to say. So, what can be done? Well, be vigilant. Be very vigilant. Be very careful about how you're spending your money. If you don't need to have a certain type of product or service and you can minimize that, then obviously get rid of it. Just have a bit of discipline if you can. The second thing is maybe you can sort of like dive deep into potentially getting a role that helps to solve some of these issues, or create the innovation, or be part of the manufacturing, or whatever it may be. There definitely be some sort of like opportunities that come for it for some people. But of course, everyone's going to feel the heat for sure. What's the third thing you can do? I think the third thing you can do is, if you are a trader or investor, I put them in the same category because it's the same market. It's just different ways of approaching it. The same knowledge is very important. Then again, one, if you're trading, look for opportunities to sell, and that's probably going to be more consistent in terms of order flow or structure. But when it comes to investing, it will probably be a case where you either decide to keep on buying, okay, at a low discounted price with the mindset that things will grow, based on the fact that that is likely to happen based on previous years, but there's never a guarantee. Or you may decide to sell your stock because actually you want to use that money for something else, for another endeavor, maybe business or emergency fund or whatever it may be, because you may be directly affected by some of the stuff that's going on in terms of your job. So yeah, that's it really. And of course, just understand what's happening. I do some of these videos. I'm not an expert in this by any means. I'm just sharing what I know based on research. But be aware, learn this stuff, understand it, go deeper, and don't necessarily put yourself in victimhood, so to speak. I know the system's happening to us, but at the same time, there are things we can do even if it is difficult and hard. And I don't say that like lightly, by the way, because I'm also experiencing it too. Just because I'm doing a YouTube video doesn't mean I'm not experiencing it. Anyway, if you are interested to hear more things around what I'm calling soft economics, portfolio careers, consulting, contracting, all of that kind of stuff, then don't forget to subscribe and hit the notification bell. And as always, my friends, understand, reach, and expand. Peace.